Hi, what I'd like to do now is talk about AASB 9 financial instruments, and in particular I want to focus on accounting for hedge transactions, and I'm going to do this in relation to an import transaction that I've previously talked about in relation to AASB 121. So just to recap, the physical transaction that we talked about previously was Poor Trading, which entered an agreement to purchase inventory from a US supplier for $100,000. It was ordered on the 1st of March, the inventory was shipped on the 31st of March, and it wasn't settled until the 31st of July. The financial year end was the 30th of June, and the exchange rates, the spot rates on the critical dates are as follows. On 1 March, 75 cents, 31 March, 72 cents, 30 June, 70 cents, and 31 July, 67 cents. Now, because POR is concerned about the foreign exchange risks to which it's exposed, it takes out a forward exchange contract on the 1st of March when the inventory is ordered. And the price for, or the value of forward exchange rates for delivery on the 31st of July are as follows. The forward rate on the 1st of March is 72.5 cents, 31 March 71 cents, 30 June 69.5 cents, and 31 July 67 cents. Just a couple of key points here. The difference between the forward rate and the spot rate is effectively an interest differential. So it sort of creates a cost for the forward exchange contract or the hedge which has been entered into. And so that's going to have to be recognised progressively over the life of the contract. And the second point to note is that by definition, the forward rate and the spot rate on the delivery date coincide. Now, before you start to think about the accounting, it's always good to get the maths out of the way first. And so what I always think about here is doing a simple table which shows the physical contract and the $100,000 being converted at the exchange rate applying at those various dates. That's just a simple mathematics exercise. And I do the same for the forward. Please note I also calculate the differences. That way I only have to do it once, and I can think about that exclusively. I then need to think about the accounting for these two transactions, and I'll emphasize right at the outset there are actually two transactions here. There's a physical transaction or a hedged item, and there's a hedge transaction. And it's, generally speaking, easier if you keep yourself thinking about these as two separate and distinct transactions. There is an association, but they are different transactions. Now, I've already talked about the physical transaction before, and so I'm not going to go into it in many detail here. Suffice to say that you have the inventory being purchased on the 31st of March. The foreign currency payable is adjusted to fair value, current value, on the 30th of June, and on the 31st of July there's a settlement, and you recognise the remainder of the foreign currency loss on this date too. My primary concern here is accounting for the hedge transaction. Now, the hedge transaction is entered into on the 1st of March, and whilst there isn't an amount associated with it, I'm going to do something which on the face of it might sound a bit irrelevant, but I'm going to recognise the fact that I've entered into a contract on the 1st of March, and I've paid nothing for a foreign exchange contract. So you can see the zero journal entry. The reason why I do this, though, is it does highlight the fact that we've entered into our hedge transaction before that we've started to record the physical transaction. And that's important because this now identifies the hedge transaction on the 1st of March as being a cash flow hedge. And you can sort of see this because there's not a matching physical transaction to offset it. And this is quite important in terms of the treatment of the gains or losses on the hedge. On the 31st of March, we received the inventory, and on that date, the cash flow hedge is changes from being a cash flow hedge into a fair value hedge. So what we'd have to do on that date is we'd have to reevaluate our foreign exchange contract, and we'd see that our contract is now worth $2,914. And because that gain has occurred while it's a fair value hedge, a cash flow hedge, that would normally go off to OCI, but because this is a purchase of a qualifying asset, it actually gets adjusted against the inventory. Now, of course, that's going to reduce the purchase price of the inventory, so it's going closer to locking in the exchange rate, which we thought we wanted to have when we ordered the inventory. And it is going to flow through the income statement when the inventory is sold as part of cost of goods sold, and it'll be matched with the revenue at that point in time. So it is ultimately flowing through the income statement still. Now, on the 30th of June, we have to adjust our forward exchange contract, and we can see that it's gone up in value by another $3,000, and we recognise that gain in the income statement. And you can see by setting it up this way that the gain on the hedge transaction is to some extent offsetting the loss on the physical transaction. I'll explain why the numbers are slightly different before, notwithstanding the fact that it is a perfect hedge. On the 31st of July, we'd adjust our forward exchange contract, and we'd recognise a gain, and we'd settle the forward exchange contract, credit forward exchange contract, credit cash. And so what you can see is there that we have this sort of matching of the gains and losses on the physical transaction and the hedge transaction. It starts off as a cash flow hedge, and it finishes up as being a fair value hedge. Now, one of the things that might concern you is that whilst it was a perfect hedge, it was effective, it was designated right from the outset, it actually hasn't matched off perfectly the gains and the losses. And the reason for that, if you're curious, it's because of the cost associated with the forward exchange contract, those forward points. And you can see in the first table there, I've identified what are the differences between the forward rate and the spot rate. And you can see that these amounts start off as being 4,598, and it comes down to 0. And you can see the changes that occur each period. Well, what that's effectively doing is identifying the cost of the forward exchange contract and how much of that cost belongs to each period. Now, not surprisingly, if you look at the differences between the gains and losses on the hedge and the physical, you can see that those gains and losses perfectly capture the cost of the forward exchange contract. So we could mechanically, I suppose, if you felt like it, separate out the hedge gains into the hedge gain and the cost of the forward contract, but there's no point and it's not necessary. So we simply have recognized that whilst we do have an effective hedge, it's perfect. It does, however, generate slightly unmatched gains and losses due to the cost of the hedge instrument itself. Thank you very much.